Good day, economic students. This is the third video in a series of instructional videos on money, banking, the money markets, and the Federal Reserve. The purpose of this specific video is to investigate the United States Federal Reserve, our central bank, and describe the makings of and reason for the existence of our nation's central bank, the Fed. So, the United States has a Federal Reserve System. The historical background behind the Federal Reserve. The Fed was established in 1913 after a series of banking crises. Specifically, a banking crisis in 1907 was the precipice for Congress to get together and decide we need a central bank to control the nation's money supply and regulate the financial system, and specifically banks. So the Fed has this job of the oversight of the financial system. How is the Fed run? Well, we have the Board of Governors, and the Board of Governors consist of the Fed chair, or president of the Fed, the vice chair, and 5 other members of the Board of Governors. They are not elected officials. They are chosen by the president, and then Congress must approve them. So we'll talk more about this idea later, but the Fed is independent of the electoral process, and the Fed's independence is an important idea. So the Board of Governors is ultimately in charge of those 7 people. Underneath the Board of Governors, you have the 12 Federal Reserve banks. The United States does not have one central bank. Instead, we have a Federal Reserve System. So 12 reserve banks. We'll see a map on the next slide of the location of these particular reserve banks. Each of the banks has its own president. So Bank of Philadelphia, the Federal Reserve Bank of Philadelphia, the Federal Reserve Bank of New York, of Richmond. 5 of the Federal Reserve Bank presidents serve on the committee to make decisions. The Bank of New York president is always on the committee, and the other 4 rotate. So we have these 12 reserve banks. We'll look at the map, like I said, in a moment. So collectively, they work as a central banking system. Now, this idea of quasi-public bank and banker's bank. So each of the 12 Federal Reserve banks is responsible to oversee the commercial banks and institutions, thrift institutions within its district. And technically, the commercial banks and thrifts within each district own the reserve bank of that area. So for instance, the Philadelphia Federal Reserve is owned by all of the commercial banks and thrifts within its district, and they own stock in the Federal Reserve Bank of Philadelphia, and they actually get paid a dividend. It's kind of an interesting setup. So here are the 12 Federal Reserve banks across our great nation: Minneapolis, Kansas City, Dallas, San Fran, St. Louis, Atlanta, Chicago, Cleveland, the mistake on the lake, Boston, New York, Philly, and of course Richmond. Now, it makes more sense for us to have a Federal Reserve System with these 12 Federal Reserve banks across the country because we have a large and diverse economy. So if you think about New York is typically the center of finance and financial goings on and happenings in the United States. Chicago, you have the Mercantile Exchange, a lot of shipping going in and out of there years ago, but still big exchange area. Minneapolis and Kansas City, more of your Midwest sort of agricultural, agrarian economy. San Francisco, of course, you got Silicon Valley not far from there, so they have sort of their pulse on what's going on with the techie world. Dallas, with oil and oil reserves, was traditionally thought of as having an understanding of the energy markets. Right, St. Louis, right in the middle of the country. So it made more sense for the United States to have 12 district banks who collectively keep watch on and have an active pulse on what's going on in the economy. So we have this Federal Reserve System, the Board of Governors, the Fed chair, the vice chair, and the other 5 members of the board, the 12 regional banks. And the Fed sets monetary policy after receiving a great deal of input from the FOMC, Federal Open Market Committee. So the FOMC is a group of professionals, a group of business women and men who own and operate or are actively participating in the economy, who have a good understanding and good feel for what's going on with the day-to-day business of business. So the FOMC receives input from these individuals because it makes sense for them to get as much information as possible, to crunch data and to exchange ideas on what's really going on behind the scenes with the economy, not just what sort of we put together from the federal government standpoint. So the FOMC receives a good deal of information from actual business people in the actual business of doing business. All right, so after receiving input information and data from all of these sources, the Fed carries out monetary policy mostly by conducting what's called open market operations. Now, we're going to talk much more detail about this when we cover monetary policy, but open market operations is a fancy way of saying the buying and selling of bonds. Now, this used to be an easy thing to explain because it was buying and selling of short-term government securities or short-term government bonds, but after the financial collapse of 2007, open market operations took on a whole new definition. But that's what open market operations means, the buying and selling of bonds. So there are roughly this many banks. There's a little bit fewer now, but that the Fed must oversee. So remember, each of the 12 Federal Reserve district banks oversees the commercial banks and thrifts within its geographic designation. So here's a nice graph of the structure of the Federal Reserve, and I should say a nice chart of the Federal Reserve. Up top, you have the Board of Governors. So sort of the buck stops here. So you have the Fed chair, currently Jerome Powell, the vice chair, 5 other members of the Board of Governors. Again, they are selected by the president and approved by Congress. They have non-successive terms. In other words, the Board of Governors, each member, their term does not end at the same time, so that we have some continuity within the board, so that that when they come up for appointment, that it's at various or different times. So underneath the Board of Governors, you have the 12 Federal Reserve banks, and in between there, we have what I described earlier as the FOMC, the Federal Open Market Committee, which helps the Board of Governors receive economic and financial input to make decisions on how to carry out monetary policy. Right? So underneath the jurisdiction of the Federal Reserve banks, you have the commercial banks and thrifts, right? And of course, these banks and thrifts, they serve the public. So this sort of gives you an overview of the United States financial system and how it's regulated. Here's a nice little graphic of the last 1, 2, 3, 4, 5, 6 Federal Reserve chair, right? So going back to G. William Miller, who was appointed by Jimmy Carter, Paul Volcker, who was also appointed by Carter, Alan Greenspan, who served as the Fed chair. Wow, look at all that time. From 1987 all the way through 2006. Right? Then Ben Bernanke, who was the Fed chair during the financial collapse and the financial crisis. Janet Yellen was our first female Fed. Actually, I had to call her chairwoman. And now we have Jerome Powell. And on the right, it shows you again which president appointed these Fed chairs. Now remember, the Federal Reserve is an independent institution, free of the electoral process, and should carry out monetary policy in an unbiased fashion to do what's right for the economy. More about this later, but it's important to understand how the process works. The president chooses the Fed, a candidate to be Fed chair, and then that candidate must be approved by Congress. So what is the function of the Fed? The Fed primarily serves 7 functions. Some of these are rather mundane. Some of them are extremely important to the economic and financial well-being of our economy. The first one is rather mundane. The Fed issues currency. If you look at any 1, 2, 5, 10, 20, 50, or $100 bill, there is a letter with a circle around it. This denotes which of the 12 regional banks issued that currency. The Fed also destroys currency when it gets dirty or dingy. This is a necessary function of the Fed, but rather mundane. The second function of the Fed is extremely important to the financial and economic well-being of the country. The Fed sets the reserve requirement and holds reserves. All banks create loans. That's how banks make money. So banks take in deposits from their customers, and they are permitted by law, which is set by the Federal Reserve, to loan out a certain percentage of all checkable deposits. Currently, the reserve ratio is 10%. So banks are permitted to loan out 90% of their checkable deposits. The Federal Reserve changed the reserve ratio from 12% to 10% in 1992. Let's use some numbers to explain this function in more detail. Let's assume Wells Fargo has taken in $1 billion from its customers in checking accounts. Therefore, Wells Fargo is permitted to create $900 million worth of loans. The other $100 million, 10% of checkable deposits, must be held in their bank vaults or on reserve with the Federal Reserve. So the Fed sets the reserve requirements and holds reserves. The Federal Reserve affects the money supply largely by altering the amount of excess reserves that banks hold. We're going to explain this in much more detail when we cover monetary policy, but it's a good idea to start thinking about this idea right now. If a bank is holding excess reserves, the bank is in a position to create new loans and therefore introduce new monies into the economy. If a bank is loaned up or has no more excess reserves, the bank cannot create any new loans. Sometimes banks fall short on reserve requirements. Let's fall back on our previous example. Wells Fargo has $1 billion in deposits from its customers. $1 billion in checkable deposits. By law, Wells Fargo at the end of business close must have $100 million in reserves, either in their bank vault or on reserve with the Fed, 10% of checkable deposits. Sometimes banks find themselves short of required reserves. Most of the time, when a bank finds itself in need of required reserves, they borrow the money from other banks. There is a market called the Fed funds market. It's the overnight loan market in which most of the time banks find a way to meet reserve requirements by borrowing from other banks. So in this instance, let's say that Wells Fargo finds themselves $5 million short. They can borrow the money in the federal funds market from Bank of America or Citizens Bank or any other commercial bank. You may ask yourself, why would a bank lend money to its competitor? If a bank is holding excess reserves, it can loan those in the overnight market to one of its competitors simply to make a small amount of interest. Now, the Federal Reserve sets that interest rate in the Fed funds market. Much more about that market in the future. But sometimes banks cannot convince another bank to lend money to it because they may seem like a bad risk. They are not in the greatest financial health or they do not look altogether solvent. If a bank cannot find another member bank to loan its overnight funds in the federal funds market, the bank must turn to the Fed, the lender of last resort, to borrow money. When the Fed loans money to banks and thrifts, it does so with what is called the discount rate. So if a commercial bank or thrift is short on reserve requirements and cannot convince another bank to loan it the money, it must turn to the Fed for the funds, and the Fed loans these funds at the discount rate. This is sometimes referred to as the discount window. Now, for the longest time, this was considered a mundane function of the Fed because 97% of the times when banks were short on reserve requirements, they met the reserve shortfalls through the Fed funds market. Only 3% of the time did banks ever need to turn to the Fed because of facing insolvency or financial unhealthiness. However, the financial collapse of 2007 introduced an entirely new approach to using the discount window to rescue banks and even other institutions such as GMAC financing. It's one of the reasons why teaching economics is so interesting, because there are new ideas always being introduced to the topic. This one's a rather mundane function of the Fed. The Fed provides for check collection. Let's say you have a buddy living in Montana and she or he sends you a text and says, "Hey dude, I'm short rent money and I need some money for my groceries, just waiting on a big check from my commission, just hasn't come in yet." And you trust this person, you love this person, so you send them $2,500 via check, you put it in the mail. The Fed makes sure that the funds transfer from your bank to their bank when they cash it, and they make sure that the check itself gets back to you somehow. Now, the Fed actually outsources this extremely important but kind of mundane function of the Fed. This is an interesting idea. The Fed acts as the fiscal agent for the U.S. government. Most citizens of the United States have a bank account. You don't take all of your paycheck and put it under your pillow or in a safe in your house. You deposit it in a bank and you write checks, whether they're physical checks or electronic transfer of funds, when you need to pay for goods and services. The federal government took in approximately $3.2 trillion in tax revenues in 2018. What are they going to do with all these funds? Well, the federal government has a bank account at the Federal Reserve. When the federal government writes a Social Security check, an unemployment check, a check to a contractor for defense spending, a check for a construction company because they're repairing federal roads or bridges, they write it against their bank account with the Federal Reserve. So you can think of the Federal Reserve as providing bank services for the federal government. This is an important function of the Fed, supervising member banks. All of the laws necessary to control bank behavior were on the books prior to the financial collapse of 2007. One of the great criticisms of Alan Greenspan and the Federal Reserve was that they sort of fell asleep at the wheel and they didn't realize how dangerous these mortgage-backed securities and derivative instruments were as far as the financial well-being of the entire economic system. But this is an important function of the Fed, to supervise member banks. There's been much discussed about and much investigated into the Fed's role of supervising banks, and the Fed has been more forthcoming about how they do this and have increased capital reserve requirements and made other changes when it comes to behavior of banks. Last but definitely not least, the Federal Reserve controls the nation's money supply. We've already looked at the money market, and we demonstrated how important it is that when the Fed wants to alter interest rates, they can either increase or decrease the nation's money supply to either lower or raise interest rates in response to economic activity. We will discuss in much more detail the tools of monetary policy used by the Fed to control the nation's money supply, but this is by far the most important function of the Fed. As I alluded to earlier, the Fed is an independent institution. All right, it was established by Congress in 1913, independent of the political process. Now, why is this so important? Is because the Fed can do what they believe is right or necessary, not necessarily what is popular at the time. So if you think about the way the political process works, politicians are constantly seeking re-election. The Fed are not elected officials, right? The Board of Governors, right, they are chosen by the president and approved by Congress. So appointed by the president, approved by Congress, but they're not politically established positions. No Fed chair, vice chair, or other members of the Board of Governors is running for office. Now, this is extremely important because it allows the Fed to take actions which may be unpopular at the time. Look at this last bullet point here. Fed takes actions to increase interest rates in order to stem inflation. Paul Volcker, Fed chair during a period of time in the late 70s, early 80s when inflation was out of control. Paul Volcker took extremely unpopular measures of decreasing the nation's money supply and pushing up interest rates to rein in inflation. Not a joke, he was seriously receiving death threats from people within the small business community because it was making it much more costly for small businesses to borrow in short-term fund markets to fund the activities of their daily operations. But even though it was an extremely unpopular measure at the time, Paul Volcker was proven correct that 18 months to 2 years after his unpopular policy decision, inflation had been cut in half. So Fed independence of the political process, extremely important to the Fed's ability to carry out monetary policy. Here are, or I should say were, the 12 largest financial institutions in 2012. Deutsche Bank, HSBC, BNP, Mitsubishi, UFJ Financial, Barclays, Royal Bank Scotland, JP Morgan Chase, Credit Agricole, Bank of America, ICBC. All right. Now, we fast forward just 7 years, financial institutions in 2019. You see that the first four, the top four now, are Chinese financial institutions. Now, this is a little bit misleading because some of these are quasi-private, quasi-public institutions. In other words, not like 5, 6, and 9 on this list where any individual can buy stock in those companies, right? The banks or the financial institutions in China are sort of a combination of state-run operations and privately held corporations. But it is interesting how China has catapulted to the world leader of financial institutions over this 7-year period. This is simply a list of central banks across the world. You can see, pretty simple, basic names here. Australian Central Bank, the Reserve Bank of Australia. Wow, right? Bank of Canada, Canadian Central Bank. The one that's a little different is the ECB, the European Central Bank. So you can think of the European Union as the United States of Europe, and they have a central bank to control monetary policy or to facilitate monetary policy in the Eurozone.